Hello everyone, welcome to the short but relevant 10 minutes concepts video number 4. In today's 10 minutes concepts video, we will talk about impact on revenue recognition when customer is having an unconditional option to return the goods purchased. This concept is based on the principles of IFRS 15 revenue from contract with customer and is equally relevant for reporting under Ind AS 115, which is an equivalent standard in India, and even equally relevant or applicable for ASC 606 reporting, which is an equivalent US GAAP accounting standard. But before we start discussing on this concept, let me introduce myself. My name is Jatin Agarwal. I'm a chartered accountant by profession, and I have an extensive experience of auditing and financial reporting now. As we all know, IFRS 15 revenue from contract with the customer is a standard that basically gives you guidance on revenue recognition for all contracts with the customers, right? And very broadly speaking, it's a 5-step model, right? In step 1, we identify contracts with the customers. In step 2, we identify the performance obligations in the contract. We also call as promises in the contract in layman's terms, but a standard says this as a performance obligation. These performance obligation then act as a unit of account for revenue recognition. In step 3, we determine our transaction price or total consideration in the contract. In step 4, we actually allocate the total consideration or transaction price that we identified in step 3 to the different performance obligations that we identified in step number 2. And finally, step number 5, we recognize a revenue basis as and when goods or services are transferred from the entity to the customer, right? Now, the underlying objective of this 5-step model is to recognize revenue at an amount that reflects consideration that the entity expects to be entitled to in exchange for those goods and services. I would repeat this. Objective is to recognize revenue with an amount. What is an amount? Amount is the total consideration that the entity expects to be entitled to, right? Why I'm focusing on the consideration that it expects to be entitled to, you know the relevance of this concept in the subsequent slides, right? So let's talk about right to return. You will frequently encounter transaction where entity gives an option to its customers to return the purchased goods. Such transactions are at least very common in e-commerce industry, right? So this option to return the goods back is commonly referred to as a right to return in IFRS 15. Let us understand what is the impact of such a right to return on revenue recognition. Do you think this right to return should be treated as a separate performance obligation in a particular contract? Or I would say this is an obligation on the entity or a promise made by the entity to the customer to be stand ready to accept the returned goods back from the customer, right? Uh, is it similar to warranty? In warranty, entity is obligated to stand ready to repair the defects, right? And sometimes warranty is treated as a separate performance obligation. So can I say that right to return is also a promise made by the entity to the customer, whereby it is obligated to stand ready to accept the goods back from the customer. Now, I would like to draw your attention back to the objective that we discussed just a few minutes back of IFRS 15. IFRS 15 objective was to recognize revenue at an amount that reflects the consideration the entity is expected to receive from transfer of goods and services. Now, if I've sold, let's say, 10 units, and I'm expecting that one unit is going to come back to me, and when I say that one unit is going to be returned by the customer, I definitely will have to repay or refund the amount that I've received as a consideration against that unit, right? Then can I say that for the goods which are expected to be returned, am I really entitled to the consideration for that good? The answer to this, to my mind, is no. So basically, for the goods that is expected to be returned, entity should not actually record its revenue. Complicated, right? Don't worry, I will try to simplify this with the help of a small example. Let's say we have delivered or sold 10 units. In a normal case, if my selling price per unit is rupees 100, I would record a revenue of rupees 1000. And if my cost per unit is rupees 80, I would record my cost of goods sold as rupees 800. Now, let's assume that 10% of the goods are expected to be returned. How should we account for this transaction? Before we jump onto the accounting, I would like you to take a pause for a moment and notice what will happen when goods are actually returned by the customer. Let's say we have an entity A Limited and we have a customer X. When customer X is going to return the goods, goods will move from customer to entity A, and entity A would then record these goods back as an inventory, right? And at the same time, since customer has returned the goods, entity A will be obligated to refund the consideration. So basically, entity A will have to refund the consideration of rupees 100. Now, I would request you to concentrate on this returning unit once. If you look at the legal status of this unit, it is sold to the customer. Entity A is not having any control over this unit. Customer X is having a possession and control over this unit. But if you really look at the substance, do you really think entity A should recognize revenue for this returning unit? I'll again reiterate the objective of IFRS 15 is to recognize revenue with an amount that reflects consideration that the entity expects to be entitled to in exchange for the goods and services. In this case, consideration for returning unit is not expected, as A Limited will have to repay on return of this unit, and hence revenue for this unit should not be recognized on day one itself. In fact, if you look at the substance, this one unit actually represents obligation on the company to refund the consideration received against this unit, and also represents company's right to receive its inventory back on settlement, right? So for goods expected to be returned, entity A has obligation to repay the consideration it has received from the customer, and secondly, a right to receive its good back from the customer. Finally, how should we account for this transaction? For goods that are not expected to be returned, entity should record its revenue. But for goods that are expected to be returned, entity, instead of recording revenue, should actually record for refund liability and also a return asset. This refund liability would represent the amount of consideration that the entity expects to refund to the customer, and this return asset would actually represent entity's right to receive goods, which is nothing but the inventory, but nothing but its inventory, back from the customer when this settlement takes place. Right? Let's understand this with the help of an journal entries, right? So if we have delivered 100 units or sold 10 units, sorry, if we have delivered 10 units and the estimated return rate is 10%, in normal case, I would have recorded a revenue of rupees 1000 and a cost of goods sold of rupees 800, right? In current case, since one unit is expected to be returned, right? I will not recognize revenue for 10 units, but I will have to record revenue for only 9 units. That is only 900 rupees. So my incremental journal entry to reduce this revenue of rupees 100 will be revenue account debit, which is 100, to a refund liability account credited, which is rupees 100. Through this entry, we have actually reduced our revenue and recorded my refund liability, right? Further, since I've recorded a revenue for only 9 units, we also need to reduce our cost of goods sold from 800 to 720, which would represent cost for 9 units which are actually sold, right? So journal entry for this would be return asset account debited rupees 80 to cost of goods sold rupees 80, right? Note that we have recorded a refund liability of rupees 100, as this is the amount that the entity will have to pay to the customer as refund. And we have recorded a return asset of rupees 80 only, as this is entity's cost for this inventory, right? Also, an important point to note is we have recorded a return asset over here. This is different from inventory. Entity will record inventory when it actually receives those goods back from the customer and reclaims control over those goods. With this, we come to an end of this 10 minutes concepts video number 4. Thank you for watching it. I hope you find this useful. Thank you once again. This was CA Jatin Agarwal. Thank you.